So Warren Buffett suggests that investors buy the index. Do you think that's good advice? And do you think that's good advice now?
I think it's great advice most of the time. And there are very few periods every 20 years or so where it's not good advice. And I think one of the things that people forget, that there is a nuance to what Buffett says about it. What he's saying is that the average person should be buying the index over time, because he's talking about people who are saving money every month or every quarter and putting it in an index fund, in a savings account, and doing it over a long period of time. So they're averaging into that index. And you will have periods like now where I think it is not a good time to buy the index. But if you've been putting money into it on average every month for the past 10, 15, 20 years, then the money that you're going to put in today, even if it doesn't do well from this point onwards, is a small percentage of the amount of money you've saved and put to work. So I think that's one nuance that I think people miss when they say Buffett just says buy the S&P 500. And then the other thing is, and the reason I think it's not a good time particularly to buy the S&P 500 is I don't think that it's a diversified portfolio anymore. If you look at the index now, half of it almost is in 10 names. And of those 10 names, almost all of them are in technology. So this is not a portfolio that is representative of the U.S. economy, which is what an index fund is meant to do.
Yeah, and there are also quite a lot of risks on the horizon that we've discussed before. So surely, if you're an investor now, and maybe even if you're really bullish on tech, actually, you know what? I'd say, especially if you're bullish on tech, this is the time to own something different. You don't have to own, you can own both. You can own Manchester and London, the tech funds. It's a great fund, 30% in NVIDIA, 20% in Microsoft. And that will do fantastically well if tech continues. But surely also owning something different is beneficial?
Well, I think economists always say diversification is the only free lunch. And it's true to a great degree, but especially important in cases where something has done well. And if you look at long-term studies of kind of asset allocation across markets and across asset classes and so forth, one of the most fundamental lessons that you get out of it is you need to be rebalancing between different things over time. And the reason is, nothing does well all the time. We know this. And it is particularly at times where one part of your portfolio has done so well that you actually should be selling some of that and putting it in the other stuff that hasn't done so well. And I think when you have a situation where tech has done so well, you do want to be taking money out of that and putting it in something that is less correlated with tech. And that could be as simple as putting in a savings account or buying some government bonds. But I think if you still want to allocate money to equities, then you absolutely have to be looking for managers who are less correlated with that. And I think one of the things that we saw in our portfolio kind of over the summer is when you had that mini drawdown in tech. So it just showed you how positioned we are, kind of almost like an anti-tech fund at the time. And we had those two weeks in August where it was the highest alpha we have ever generated. And I've been investing for 25 years. I've never seen numbers like that. It just shows you how quickly these things turn. But most importantly, it shows you how differently positioned we are and how owning something like us is good in your portfolio to kind of balance out any drawdowns from tech.
Yes. So if you're worried about the risk that NVIDIA is overearning, that Tesla's sales are starting to slow or go negative, not to mention companies like MicroStrategy and all the others, US mortgage rates, they're hitting highs that we haven't seen in 20 years? Inflationary pressures, rates going up. All these things, could damage tech. And, a fund like ours is the only thing that will, not the only thing, but the sort of thing that will help diversify your portfolio so that hopefully you still make money as a whole, during a period like that.
And then the other thing, I was having a conversation with a client the other day, and I was like, as investors in liquid assets, we have this tremendous option that other people may not, which is we can make continuous decisions over time. And so when we say we're not going to invest in tech today, we're not locked into this decision for the next 20 years. If you look at what happened kind of post the dot-com bubble, you may have been standing there in 98 and 99 and looking at Cisco or whatever other tech names and thinking, oh, this business is going to do well over the next 8, 10, 20 years, and I don't want to miss out. And it's true, like you said, it did do well over the next 8, 10, 20 years. But you didn't have to buy it then. You had a lot of time to buy it in 2002, 2003, 2005, well, pretty much up until...
And then you'd have made fantastic returns.
And then you would have fantastic returns, exactly. And that's what we did, for example, with Microsoft and Google and Apple in 2010 and 2011. So when we say we don't want to be buying tech today, this is not a permanent decision that we're locked out of this opportunity.
It's just temporary. But it's also temporary. It's more than that because we actually do own tech. It's not that we're anti-tech at all. We own Google, we own Capgemini. We do own tech names, but just not the ludicrously priced ones the ones that we think are ludicrously priced.
And we will own other ones when prices come down, and they will come down. History teaches us that. I mean, this is not a one decision game. It's you. One of the beauties of being, again, in a liquid market is prices change all the time. So it gives you the option to buy into things when they are more reasonably priced, ideally hated by others. And by owning boring things now and being more conservative, we are protecting our capital. I think we're still going to earn a very good return in the interim. But when these things come down, you can sell the boring stuff that's gone up and go and buy some of the tech names that got killed. Because frankly, history teaches us that markets tend to overreact. And so just as they've overreacted on the way up, they will probably overreact on the way down. And we will get an opportunity in the next few years to buy wonderful tech companies at reasonable valuations.
Lots to be excited about then.
Absolutely. I think, again, I really have a very high degree of confidence in the prospects for our fund and our strategy and other people who are in a similar position to our strategy over the next 3 to 5 years. I think it's going to be an exceptional period for fundamental managers who are focused on value, who are focused on diversification, and who are focused on quality.